Hi, I'm Steve LaFrance with Blakely Financial. Stocks traded higher for a fourth consecutive month in February, with the rally broadening after large caps accounted for most of January's gains. Let's see what's happening. The S&P traded above 5,000 for the first time, setting a new all-time high, and has now returned over 21% since the start of November. The Dow Jones set a new high in February, and the Russell 2000 outperformed the S&P after trailing by 5.5 percentage points in January. Bonds traded lower as the January FOMC minutes revealed a hawkish tone from several members of the committee, and multiple inflation reports were slightly hotter than expected. I'll come back to this, but to be sure, the January year-over-year CPI report was only up 3.1%, the slowest since March 2021. Yet the Fed's target remains 2%, and there are several trends suggesting this target may be more difficult to achieve than recently anticipated. Most participants from the FOMC meeting warned against cutting rates too soon, while only a few participants expressed concerns for holding a restrictive stance for too long. And many investors are now expecting just 3 rate cuts this year, a decrease from the 6 cuts forecasted at the beginning of this year. But some are suggesting we may not see any Fed rate cuts in 2024, and here are some notes and charts from Apollo's chief economist Torsten Slot to explain why. His analysis shows the economy is not slowing down. It is in fact re-accelerating. Growth expectations for 2024 saw a big jump following the Fed pivot in December and the associated easing in financial conditions. As I mentioned earlier, Apollo references several trending data points to show underlying measures of inflation are moving higher. And supercore inflation, a measure preferred by Fed Chair Jay Powell, is trending higher, providing some headwinds. Labor markets remain tight. Jobless claims are very low, and wage inflation is sticky between 4% and 5%. Surveys show that more small businesses are planning to raise selling prices and raise worker compensation. We're also seeing higher trends in both manufacturing and ISM services prices paid. Keep in mind, these are all relatively small upticks, but collectively, they will present resistance towards getting inflation down to 2%. With inflation conditions easing significantly since December, it is not surprising that we saw strong non-farm payrolls and inflation in January, and while expecting the economic strength to continue, just means the Fed will likely spend most of 24 fighting inflation. So how is it our equity indices are hitting all-time highs? Well, in addition to the anticipation of lower rates, AI has something to do with current valuations, and we'll discuss that more in a future update. For the time being, there's a lot to keep an eye on while the economic trends continue moving in positive directions. But the biggest takeaway from last month was the market's new expectation for a delay in the Fed's rate cuts. That's all for now. Take care of yourselves, and thanks again for your trust and confidence.